everyone, this is Vaishali Siddhappa and welcome to my channel Complemental Economics, and today's class I'm going to talk about multiplier. The question is, explain the multiplier mechanism. This is one of the 6-mark question. So let's talk about multiplier mechanism. Before that, we have to talk about the last video topic, which is investment. So let's talk about investment. Whenever the investment is going to change, just assume the last exact previous video of mine, which is aggregate demand changing, that video if you're going to watch, you will understand this particular video also. So the change in investment, which was at the beginning, the investment was 10, that got increased to 20. When the investment was 10 increased to 20, what is going to happen? When investment is going to increase, that means we have to come with a conclusion that production is also going to increase. If the investment is increasing, production is also going to increase. If I want to produce more number of goods, for that I need factors of production. What are the factors of production I need? I need land, labor, capital, organization. These are all called as factors of production. The factor which is really important to produce any of the goods and services, if you want to convert input into output without using it, these all factors of production, it is impossible to produce any of the goods. So now, to produce more goods, because investment got increased, because of that the production is increasing. To increase more production, so what we need is we have to use more factors of production. The factors of production, in that case I have to use more quantity units of land, labor, capital and organization. In this, we have to assume one of the thing. What we have to assume is there is absence of indirect tax and subsidies. Please do consider this. This is one of the assumption, but in practical way, indirect tax will be there. Whatever the goods you're going to produce, you have to pay indirect taxes. For the few of the goods, government is going to give us subsidies. So we have to take account in the real facts. But right now, we are just assuming in that case, absence of indirect tax and subsidies will be there. In this case, you're going to pay for land, you're going to pay for labor, you're going to pay for capital. After that, whatever money will be left, for that you're going to pay as a profit to the organization. So let's see how it will be classified. Whenever you're going to take land, you're going to hire a land, you're going to pay rent. Whenever you're going to use anybody's labor, you're going to pay them reward as a wage. If you're going to use a capital, you're going to pay interest. After paying this, whatever money will be left, so that will be called as a profit for the entrepreneur or for the organization. So in this case, the money what you have, so that will be the investment part what we have done, that is distributed to the factors of production to purchase the factors of production. For the factors of production in the terms of like rent, wages, interest and profit, finally it is reaching the people, otherwise you can say consumers. It is reaching people, otherwise a consumers. So then combining the total factor payment, this is called as factor payments. Factor payments combining everybody's income, that will be called as national income. The national income is completely equal the aggregate value of all final goods. Whatever goods and services you are producing, the national income will be exactly equal to it. So now, as I told you, everybody's income increased. How it increased? Because few people got rent, few people got wages, few people got interest, few people got profit. So this will be a factor payment, individual income. When income is going to increase, everybody's income is going to increase. Definitely consumption is also going to increase, isn't it? Whenever my income increases, consumption also increases, because right now we are talking about induced income, induced consumption. Whenever my income increases, definitely what I'm going to do out of it is I'm going to spend a lot of money. So that is what I'm doing here. My income got increased, so I'm going to spend a lot of money. So that's called consumption expenditure. So this is nothing but this number, it's showing nothing but MPS. Marginal propensity to, sorry, it is MPC. Marginal propensity to consume. That means if 10% of investment is increasing, 10 rupees of income is increasing, out of that how much money I'm spending. So out of that I'm spending 8 rupees. So the percentage wise, if I'm going to take 0.8% money I'm going to spend, that's called as a MPC, marginal propensity to consume. Out of 10 I'm spending, the MPC will be 0.8. If consumption expenditure is increasing, that means I'm spending a lot of money for the goods and services. That means aggregate demand for in the economy, it is going to increase. Aggregate demand, in that you have consumption and investment. If you remember my first and second, third videos of this chapter, aggregate demand combines consumption and the investment. On the basis of that, investment is increasing. If investment increases, consumption also going to increase. In that case, aggregate demand is going to increase. If aggregate demand is going to increase, supply will be less, demand will be more. And the excess demand, again, it's going to match up with this supply. Supply should be matching with the excess demand. In this way, again, we'll take a next cycle. So here excess supply is there, we have to match that with the supply. If you match that with the supply, what you have to do is you're going to increase again investment. With the investment, production is going to increase. If production is going to increase, the factors of production, the usage of that is going to increase. Through that, factor payment will be distributed to the people. Through that, income is going to increase. If income is going to increase, consumption expenditure is going to increase. If the consumption expenditure is going to increase, aggregate demand is going to increase, excess demand is going to increase. Again, we're going to bring back to the next round. So this way, once at the initial time, how much ever the money you're going to invest, that will be multiplied again and again, just like a first round, second round and the third round. I'll tell you how it's going to change in the next one. So in this one, you can see the initial income. Just now I discussed about the initial income. So in this case, the investment is going to increase. Because of that, the production is going to increase. Because of the production, the income of a people is going to increase. If income is increasing, aggregate demand is going to increase. If the aggregate demand is going to increase. If the aggregate demand is going to increase, again, you have to match up with aggregate demand. It should be equal to aggregate supply. To match with this, you have to increase the supply. If you want to increase the supply, again, you have to increase the investment. So this way, again, this is the first round. This is the second round. In this money, whatever the profit you got, again, you're going to increase the investment. Again, you're going to increase the production. Income is going to increase. Aggregate demand is going to increase. Just like a circle, again and again in a round wise, round 1, round 2, round 3, round 4, like this, the investment what you have done at the beginning, which is called as the initial investment, that's going to multiply again and again in a round wise. So that is called investment multiplier. The initial increment, the initial investment what you're going to do, that's called as investment multiplier. That is going to multiply by round 1, round 2, round 3, round 4, just like a circle, again and again. The investment what you have done at the beginning, that will be rotating in the circle in an economy, and again it is going to create more and more investment, production, income, aggregate demand. Again, aggregate demand will be equal to aggregate supply. To match up with that, you have to increase investment again. So this way, round by round, the investment is going to increase. That's called investment multiplier. So I hope you have understood the topic. Please subscribe and share if you're really liking my videos. Thank you so much.